So again, welcome. Just a reminder to everybody here that it is being recorded, so we kind of have to keep the noise to a minimum so our webinar friends can hear us. Those of you on the webinar, if you have any questions, please ask them via chat, and we'll try to get to them toward the end. But I'm so glad to see everybody here and on the webinar. This is probably the most important session you'll attend within the next couple years. Major changes are coming. Just a thought for brokers or managers, you may want to make this webinar mandatory for your office. All right, I'd probably make them watch it in the office and check off, because if they don't do it right, you're in trouble. So I'd like to present Toby and John, who've been gracious enough to put this session together to help us out. Two wonderful affiliates. If you don't use affiliates, this is a great reason why you should use them. They spend a lot of time and give us a lot of their information to ensure that we do it correctly. So pass the word along. You don't want to be the only ones out there that know what's going on. So thanks. Have a great day, and good luck. Toby and John.
Good morning. My name is John Peck. I'm a lawyer in New London, for those of you who don't know me. Toby's a lawyer in New London as well. Please don't hold that against us during the course of today. We've divided this into basically halves, and you get the privilege of listening to me for the first half. I'm going to try to teach you a little bit about what the new law is, where it came from, what it looks like on paper, and then the second half of the seminar is going to be talking about the practical applications of how this law is going to affect all of us. I mean, obviously, we'll touch on that as we go through. The first thing, out with the old, in with the new, and the question is always better. So there was an organization that was set up pursuant to the Dodd-Frank regulations called the Consumer Finance Protection Bureau. They decided in their infinite wisdom that we have too many forms. This is among other things that they decided that we'll talk about as well. But one of the things that they decided is that we have too many forms. The banks, the closing, there are 4 forms. 4. You have a good faith estimate, you have a truth in lending, that was given at the initiation of the loan, you have a settlement statement, and a truth in lending number 2. Well, that's way too many. As a matter of fact, it's double the number of forms that we should have when we do a real estate closing. So in their infinite wisdom, they've decided that we need 2 forms. One's called the loan estimate, the other is called the closing disclosure. And how this affects your life will be the subject of the next hour and a half of your existence, listening to hopefully me give you some information and Toby tell you how it's going to affect your life. So the first thing we're going to look at is the loan estimate. So this is the form that has to be given to the borrower, to the buyer, when they make application for the loan. And this information, the information contained on this document is very similar to stuff that you've seen in the past. It's 3 pages long. It replaces the good faith estimate and the truth in lending. So hopefully it makes both of those forms more understandable. Wow, bouncy. The lender's not allowed to revise or redisclose except under certain very specific circumstances. And as a result, the borrower should have a very good idea of what their loan costs are going to look like. So now we have the good faith estimate, and we have sections that can change, sections that can change by up to 10%, sections that can change by any number. That gets further restricted so that there are lots of charges that now we're within the 10% change area that can't change at all, obviously for the benefit of the borrowers. This is all done, and I mean, I think as realtors, you should understand this. This was all done because in 2007, everybody realized that the economy was melting down and the mortgage industry was in effect dying, that things were way too lax in the past, and borrowers had no idea what they were getting themselves into. So adjustable rate loans, prepayment penalties, things that came back to haunt the entire industry is what gave rise to what we're talking about today. Even if the lender makes a mistake, it's not going to be a legitimate reason to change some of these numbers. So for instance, the lender takes an application, they take an application based on a contract, they think it's a single family home, They quote an appraisal fee of $450. They find out it's a multifamily home when the appraiser goes out there, and the appraisal fee would be, in that circumstance, $550. That will not be a sufficient change for the lender to be able to change that number. So that doesn't affect you guys so much. Certainly it affects the banks, and certainly affects the borrower, because in that circumstance, the borrower will not be in a position where they have to pay that extra appraisal fee.
What if it's the other way?
I'm sorry?
What if it's the other way? They charge you $550.
That's never going to happen.
That's never going to happen?
No.
Okay.
No, I mean, if it does, everything can always go down. All of these things are supposed to be for the benefit of the borrower. So in terms of asking questions, if you guys could raise your hand, give us an opportunity to repeat the question so that the people in the audience can hear it, I'd appreciate that. And if you can possibly keep your questions till the end of my presentation, that'd be even better. If there are things that really are confusing, feel free to raise your hand and we'll try to get to them. Thanks. So this is what the first page of the loan estimate looks. And what you're going to notice when you see the loan estimate and the closing disclosure, and you have copies of both that were given out to you as part of the presentation materials, is they look remarkably similar. And that's the idea, right? The idea is that you have a bunch of borrowers who aren't necessarily educated in the process. So if you give them something at the beginning, and then you give them something at the end, and they look similar, it'll be easier for them to understand it. You have to understand where these people are coming from. The CFPB is what they're called. They're assuming that everybody's an idiot. It's really what it comes down to. And that includes you and me and everybody else. And they're here to protect you and me and everybody else. So the first page of this thing shows basic information, which is the top. It looks a lot like the information that you see on the top of the HUD-1 settlement statement now. Contains loan terms, projected payments in increments. So right now you're seeing increments 1 through 7 and 8 through 30. It could be 1 through 30. It could be 1 through 5 and then 5 through 10 if you're dealing with a five-year adjustable. And then at the bottom, costs at closing. And then I think something that everybody should be happy about seeing is down here at the bottom of the closing statement, there's estimated cash to close. Everybody knows that's been in this business for a while that in 2010, when they came out with the revised good faith estimate, they eliminated cash to close. So most lenders, when they did a good faith estimate prior to 2010, let the borrower know how much they were going to need or some estimate of that. When they were mandated to use the good faith estimate that HUD provided, there was no cash to close. There was a big uproar. HUD didn't really care. So that's back now because it's better for the borrower to understand that now. Don't forget what it's going to create when we get to the end of the transaction, and that number is different for whatever reason, whether it be fuel adjustments, tax adjustments, which aren't taken into consideration in these good faith estimates, but at least they'll have some idea of what the cash to close is. So on page 1, again, basic loan information. Interestingly, and this is sort of another override to all of this, there are things changing in the settlement service industry. So Toby and I are in the process of dealing with lots of changes that were mandated under Dodd-Frank and then implemented by the CFPB. This loan estimate is a first good example. So you'll notice the top has names, addresses, property address, sale price. On the right side, you have loan product that they're looking to buy. Interestingly enough, here they have loan ID number. So now, the interesting part about that to me is that when you put a loan ID number with the name of a borrower, you've now created a situation where that document is protected by Dodd-Frank and can't be disclosed to third parties who aren't the borrower. So theoretically, you guys won't see this document unless it's handed to you by the borrower. The lender can't give it to you directly without the borrower's consent. And how they're going to handle that, I don't know. Same rules apply to settlement service providers. So when you call us and say, hey, by the way, do you have a loan estimate? Can you send it to us? The only way we're going to be able to do that, as much as we like you and want to cooperate with the way this is all plays out in real life, is to get the borrower's, theoretically, the borrower's written permission to do so. And that's because non-public private information is contained on this document. Non-private public information is considered any combination of certain things having a loan number, which identifies a loan transaction with the borrower's name, would be those two pieces of information. Those same two pieces of information exist on the closing statement, in the closing disclosure. And as a result, you might not be getting those either. But we'll talk about that a little bit later on. Down here, down at the bottom, you'll see basic loan terms. This is not something that is any different. However, the format in which it's presented is a little different. The loan amount, can it increase? Well, on the closing statement now, the HUD-1, page 4, the last page of the closing statement, it asks certain questions at the bottom. They're addressed in the loan estimate. So can the amount increase? No. Can the interest rate increase? No. Obviously, if it was an adjustable rate loan, that would say yes. Principal and interest, and then prepayment penalty and what that prepayment penalty could be, not just is there a prepayment penalty. The next section of that settlement statement shows the payment calculation. So for instance, again, in years 1 through 7, this example shows a payment. 8 through 30 shows the same payment. That may change if mortgage insurance is going to go, well, I'm sorry, in the second one there's no mortgage insurance, but as mortgage insurance reduces over time, the payment changes. There are certain increments of years that need to show. All softwares that lawyers use and lenders use will be able to increment this the way the federal law requires. And then halfway down this page, you'll see the estimated taxes, insurance, and other assessments. That information will be generated based on the information that you provide to the loan officer, and then some estimated number that all loan officers use for insurance. That obviously is subject to change to the extent that homeowners insurance is not determinable at the time that the loan estimate is given. At the bottom of this, it shows estimated closing costs, which are lender-related fees necessary in order to close. And then at the bottom, the cash to close, which again is new for this form over the existing good faith estimate that's given out now. So all this stuff, as you know, and I probably didn't say enough, all this stuff goes into effect as of August 1 of 2015. That is applications taken for new loans taken on or after August 1st of 2015. There was a hope that we would be able to try this, like give it a shot, try it out, see if the software worked, all of that stuff. That is not the case. When it goes live, it's either a crash and burn or a huge success. I think that ultimately, right now, I don't think we have any lenders in the room. Last time we did this, we did, but the lenders are still hustling. Toby and I have both been to seminars where there are lender, mostly compliance people that are speaking on the behalf of lenders, and they're all really a little scared because it's a big change for them. And we'll talk about some of the changes that are bigger for you. These documents, obviously, they affect you. You need to understand them because your borrower is going to count on you to at least have that basic knowledge. But there are some things that are affecting the lenders, not just a change in form. So page 2 of this document has a detail of the loan costs, other costs, and how we've come up with calculating cash to close. Again, a lot of this looks sort of like a settlement statement, sort of like a good faith estimate, a little bit of both. The second page shows closing costs. Now, this is very, very important stuff that you need to know now. That these things, because we are basically a bunch of morons learning this stuff, all of the charges that you're going to see on this closing statement by section have to be in alphabetical order. So it's very important because if it's not in alphabetical order, it could be confusing to the borrower, and we don't want that. Now, the good news is it's in alphabetical order. The bad news is that every closing might be different because it might have a different charge. And since it has to go in alphabetical order, you can't rely on like the first 5 or 6 lines of every section to be fixed. They're not. They float. All of them float. And this is something that happens on the loan estimate. It also passes through to the closing disclosure, which we'll go over in a minute. Everything has to be in alphabetical order. Title issues, down at the bottom you'll see title issues first have to say title, then they have to be in alphabetical order. Okay, so title, 5 of them, alphabetical order by what they are relating to title. Very important that you understand this. Oh my gosh. In purchase transactions, this is something that's also changing a little bit. You know, title insurance, most of you know, not all of you know what title insurance is. I'm hoping that most people are still not selling against title insurance. Back years ago, probably back in the 1980s and 90s. 1980s and 90s. I hate to say that I was actually doing this stuff then, but we had agents that would stand up in a room and they would say, yeah, I tell my clients they don't need title insurance. And I always used to laugh at those people and suggest that they keep their malpractice insurance up to date, because when there's an issue that title insurance would cover, they can go back to you for that rather than Toby and I, who recommend title insurance all the time. But one of the things about the way this is set up now, and it's subject to discussion, is that title insurance has to be disclosed on this good faith estimate a little differently than we would typically disclose it. So as most of you know, and I'm just going to take a minute to talk about this, as most of you know, title insurance is basically a regulated product, and there's a fixed fee for an owner's title policy of title insurance. So let's say you're buying a $100,000 piece of land or real property, and the title insurance premium for that is $440. If you get a loan for that, and you borrow, let's say, $80,000, the lender's policy for $80,000 would be $380. But since you're buying the owner's policy, you get the lender's policy for free, basically. The way CFPB wants this disclosed is they want to show the loan policy at $380, but then they want the lenders to show the owner's policies as optional at $440, which is, on the one hand, cool, because the borrower has got that cushion now that they're not going to end up having to pay at closing. They're going to save $380 in that example. But the other side of life is they're going to think that title insurance is costing them a whole lot more than it is. Again, if any of your clients have any issues on title insurance, you should not be talking to them about that. In my personal opinion, I don't know if you disagree, every attorney that you do business with should, if they don't find a new one, be willing to talk to your client about title insurance. I talk to probably 5 clients a week trying to explain what title insurance is and why clients should buy it. But this is not a seminar on that. Okay, sorry, I'm one ahead of myself. So this is basically a slide that explains what we just talked about, the owner's title insurance rule and how that's changed from the past to the current. Again, you'll notice all of these things are up here are in alphabetical order. The costs associated with taxes, prepaids, escrows, other, there's that title again, owner's title insurance optional, and that's the whole premium amount right there. And then down the bottom, calculating the cash to close basically shows all of the numbers that would be on the closing statement. Now, obviously, this is still an estimate, so there are still numbers that are going to be added. There's still some numbers that are going to change. Loan estimate page 3 is basically informational and in part talks about your loan, but also just gives basic information. So the top is informational again, comparisons, other considerations, we'll talk about that in a second, and confirming receipt of the good faith estimate. You'll notice that in the old good faith estimate in 2010, it was considered a disclosure, as all of you know, because you've all taken many classes on this. Disclosures need not be signed, even though it's a good idea to get them signed to prove that you actually delivered them. The old good faith estimates had no signature line. The Secretary of Housing and Urban Development said, hey, it's only disclosure. There's no reason for a signature line. CFPB wants one, and therefore we have a signature line now. The top shows certain information, some of which is brand new. So as if APR wasn't confusing enough, we now have added a couple of other things. In 5 years, how much will you have paid total for your loan? And how much of that will be principal? Interesting information? Sure. Necessary information, in my personal opinion? No, absolutely not. But CFPB believes that borrowers should have this information before they sign up for the loan. The second one is APR. Again, it says it's not your interest rate, which at least gives the first part of the story to explain to a borrower what truth in lending and APR really is. And then the new thing is called TIP, or total interest percentage. The total amount of interest you will pay over the loan term as a percentage of your loan amount. Now there's a good one. I mean, because, you know, how could we have lived the last 50 years of our life doing this stuff without knowing that TIP even existed as the statistic? Now we have it on the closing estimate and the disclosure. And then information, like there, it tells you things that you should expect of your lender. They have the right to order an appraisal, and they have their obligation to give it to you. The loan may or may not be assumed. It tells you that you can obtain homeowners insurance from wherever you want. Late payment, if this is a refinance transaction, refinancing of your loan, here's more information that you probably don't need. Whether you can refinance depends on your future financial situation, the property value, and market conditions. Now, the reason why this was added, right, everything happens for a reason. Every new form in a closing package is because somebody got sued about something. In this case, we went through a period where we had properties that lost value, people were in adjustable rate loans, they couldn't refinance without the HARP program, and so CFPB wants you now to understand that there may be a circumstance in the future where refinance is not available to you for a variety of reasons. All right. When does this document have to be provided? It has to be provided within 3 business days of receipt of an application. And since we define it by the receipt of the application, we need to define what application is. So, CFPB has done that for us. How lucky are we? Application automatically occurs when the lender has these 6 pieces of information. Now, interestingly, all of this can be gleaned from a lender at the initial meeting, could be determined by a lender in basically a phone conversation. So once the lender has this information, name, income, as provided by the borrower, not verified income, social security number, property address, estimated value of the property, which can be given by you or the borrower, mortgage loan amount, they then have to provide this document. And they have to provide it within 3 days of receipt of the information. Again, all because CFPB knows best. No fees can be charged. Yes, Jeannie?
On that slide before, the lender will typically learn all 6 of those items at a pre-qualification or pre-approval session.
Well, a pre-approval, assuming that you're submitting it with a particular contract. You have to identify the property.
Yeah. But if it's not, suppose it's not negotiated yet, but you still need to know where you stand. Doesn't matter. As long as it's not negotiated, it doesn't count for application.
I mean, what Jeannie's asking is, basically, are these 6 items real, right? I mean, is it true that if these 6 items are provided, they have to provide a loan estimate? And the answer is yes. If you're contacting a lender asking for a pre-approval or a pre-quals, who does those anymore? I mean, pre-approvals are what we're looking for from anybody. You're approved to borrow this sum of money. In that circumstance, when you're giving one of those to a borrower from a lender, you typically haven't identified the property you're going to buy. And if you haven't identified the property, you do not, as a lender, have to provide the loan estimate. Once you identify the property, so once I've been out there in the marketplace and I've identified the property, once that last piece of information is provided, the loan estimate has to be given within 3 days. All right. No fees can be charged to the borrower until that loan estimate is given. So again, protecting the borrower, and a provider list has to be given to the borrower at the time that the loan estimate is given as well. So the provider list can be those people who the lender is going to require be used for certain items. If they require it, or if they have a preferred list, it has to be given to you. So what you're going to find as it relates to settlement service providers, for example, is that lenders are going to start cutting back on what they're going to disclose on that list. So, and the reason for that is for all the reasons that Toby and I are going through all the crap that we're going through that we may or may not get into at length today in order to satisfy the requirements of Dodd-Frank through the lender down to the service provider like us. In any event, the borrower has to provide this list of providers that the lender will use at the same time that the loan estimate is given. And it's no different than what they've given in the past, right? I mean, they all give a list. Some of the people you don't even know, but the list is there. And this is what that list will look like. Again, the form is important to CFPB. The form is not negotiable. It has to look like this. The loan estimate has to look like the loan estimate. It is the published form. It's the only approved form. They can't mess with it. So the second document that comes into play now that we've got this wonderful organization looking out for us is the closing disclosure. The closing disclosure takes the place of the HUD-1 settlement statement. The HUD-1 settlement statement therefore becomes not extinct because it'll still be used in certain circumstances, but it'll become something that you'll see much less of as you go forward. Just about any 1 to 4 family loan that can be purchased on the secondary market will have a closing disclosure rather than a HUD. And it replaces the final truth in lending, so we won't have that form as a separate form anymore. And it's one closing disclosure required for each loan. So if there's first loan, second loan, some lenders used to be able to put the first loan on the first and the second loan on one settlement statement. CFPB says that if a closing disclosure is required for a loan and you have 2, then you need 2 separate closing disclosures, 5 pages each. And as I said earlier, the loan disclosure and the loan estimate, or the closing disclosure and the loan estimate, look very similar. So page 1, again, should be a repeat. Closing disclosure has basic information, loan terms, projected payments, costs at closing. This one will be actual costs at closing. We're seeing basic information at the top. Loan terms, again, same stuff that we talked about. They add whether there's a balloon payment. And again, if you remember the current HUD, the last page that got added in 2010, all of those things that we go through that are checkbox at the bottom, those are now just put in different places on the closing statement. So the loan balance can't rise, the interest rate can or cannot change. If there is a change, it'll explain how that change takes place, what the projected monthly payment of principal and interest is, and then if there's any prepayment penalty or balloon payment. Again, same thing, projected payments in increments of years. This will be way more relevant in situations where we have adjustable rate loans, or in situations like this where you have MI that's going to disappear at some period of time, and then a aggregate of the assessments associated with the closing. The interesting thing, I guess, that they've added is if there are association dues that are payable monthly, those should be included on the loan estimate, even though they don't aggregate up into the payment. So theoretically, condo fees, things like that it'll be interesting to see if, how this plays out with respect to homeowners association. If you're dealing with 10 houses that have open space and they have $75 a year worth of dues, whether we're supposed to be dividing that by 12 and then putting that number into there, I don't know how that's going to play out. The closing cost section, again, it aggregates what we used to see on page 2 of the HUD-1 settlement statement and brings it forward onto page 1 and then into a bottom line cash to close number, which is everything else that we're going to get to when we get to pages 2, 3, 4, and 5. How excited are we? Let's move on. Page 2 of the closing disclosure looks remarkably similar to a HUD-1 settlement statement because it is very close to a HUD-1 settlement statement, except that every line is open when you see this thing blank. And when you see a HUD-1 settlement statement blank, you have fixed lines for various things. So everybody knew that in the 700 section, you had real estate commission. Good luck finding the real estate commission on this particular form. It does not exist. No, we got it down the bottom. I'm joking. We have it down the bottom. But interestingly, it's on the bottom in a seller paid column, and we're going to talk about how that's going to play out for everybody in just a little bit. Everybody take a deep breath. Okay. So up here, we're an origination fee. That's the 800 section. There used to be that line, adjusted origination fee. That's the number that couldn't change from application through closing. It still can't change, but again, it's in a section with a whole bunch of other stuff, origination charges that are broken out, and those are things that cannot change. Section B is stuff that the borrower can't shop for, and that will be in alphabetical order. So appraisal will generally be first, credit report, and then we'll see what happens after that. It all depends on what exactly we're putting in there. The services that buyer did shop for is in the next section, and let's see, it'll be easier to see when I make it bigger. So again, cost descriptions have to be substantially similar to the description on the loan estimate. When they say substantially similar, they pretty much mean exactly the same. But saying that would be way too easy. And that's an interesting thing, because you think about all the lenders in the world, and there are quite a few, and they've all described things just slightly different. But now they can't. Now they're supposed to all be the same. So that's part of their programming nightmare that they're dealing with right now. Again, services they can shop for, services they did not shop for. Those are things where the lender dictated where they must go. And then services the borrower can or did shop for in the next section. That aggregates to a total loan cost. The lender title rule, again, same thing. Connecticut, they're still talking about how they're going to disclose title insurance. On the final closing statement, ultimately, the borrower is not going to get charged incorrectly. I mean, the rates are all filed with the insurance commissioner. They're going to get charged the right amount. How it shows up, I think, unless, Toby, you've heard something in the last couple of days, it's still something that's being discussed. This looks like the bottom part of the HUD with a couple of other things thrown in. So government fees, prepaids, after that, that's, they pay their homeowner's insurance in advance, prepaid interest, taxes. Again, very important, it's all in alphabetical order, right? And then escrows, amounting to escrows. Section H is other, again, in alphabetical order. Notice real estate commission to alpha, real estate commission to omega. I have no clue whether that's listing selling or whether it's just because alpha and omega create the alphabetical order. I don't know. We shall find out when we do our first closing disclosure on our new software. Sure, you guys will be sitting there with bated breath when you look at your first one, sometime at the end of August or the beginning of September. Probably the beginning of September if we're lucky. Page 3 looks a lot like, let me just go back, looks a lot like page 1 of the current settlement statement. It's because the summary of all the charges, it gives us gets us to a bottom line. Again, shows you calculating cash to close, and how we get to the bottom line. It shows the borrower a comparison on this form of what the loan estimate showed and what the final HUD-1 shows and how badly the estimate was. Hopefully it'll always go down, but I wouldn't hold my breath, and so therefore we'll have lots of opportunity due to a rule that we're going to talk about in a minute to explain to a borrower what the heck they're looking at when they're looking at this form. Again, a summary of the transactions, and then page 4 shows what looks like page 3 of the loan estimate. Remember? Everybody remember? Everybody remember? It has more definitions. So is the loan assumable? Does it have a demand feature? What is the deal with late payment? Neg-AM, I don't know if anybody remember Neg-AM. Neg-AM goes back to the 80s. We haven't had one of these for a long time, but it's when the principal wasn't satisfied, the total interest wasn't satisfied by the payment each month. So they took that interest and rolled it back into principal. I'm not saying this for a historic lesson. I'm telling you this because at some point somebody might say, oh, what does negative amortization mean? So what it means is if your payment was $1,000, but the interest that accrued on your loan was $1,200, they would take that $200 and they would apply it back to principal. It would add to the principal, and your principal balance would therefore go up and up and up until you got lucky and sold the house. So life was good when property was appreciating. Life would have been really miserable starting in 2007. What happens, or can you make partial payments? You're giving a mortgage in what house? Down at the bottom. And then escrows. In the future, it talks about things. So again, this is all about education. So in the future is, what happens in the future of my life? Will I ever have to make more money in payments? Well, I'm just dealing with somebody in my office who just got a notice that their taxes went up by like $900, and they were tight to begin with, and now they need to come up with the $900 for last year, and then we're going to increase your escrows going forward. So that little paragraph there is supposed to explain to them that. It's a little late, but what the heck, better late than never. Page 4 of your closing disclosure. Page 5. This is sort of interesting for you guys. You might not have known this up until now, but there is lots of information that is now going to be disclosed about you on the closing disclosure. So first of all, the loan calculation, that again is calculation of APR. Well, how do we calculate APR? And that new TIP, total interest percentage amount. Some other information about the appraisal that you're entitled to it. And then halfway down, halfway down, we have contact information. So what is this and why is this on the closing statement? And how will this affect me now and in the future? So on the one hand, you could say to yourself, now that I am going to be shown on every closing statement, not only is my agency going to be shown, but my name, my license number, my ID if there is any kind of ID, MLS ID, contact state ID, your email address, your phone number. All this information goes into the closing disclosure. Now, on the one hand, you could look at that and say, what a great marketing tool, right? I mean, when they go to sell their house, all they have to do is pull out their original closing disclosure and boom, there I am, all my information. Or, if you're a conspiracy theorist, you can think that this is the way that the government is going to be able to see every one of my transactions. Because remember, this is a government form that has required fields and required places. So if every lender has to maintain this information, it's not that far of a stretch for the lender to be able to provide that information to the Consumer Finance Protection Bureau. And once the Consumer Finance Protection Bureau has that document, they can pull off any information they want. So where would this be relevant for you? If every transaction that you did in the last 5 years goes to the same lender, do they care about that? Could that be steering? If everyone goes to the same settlement service provider, same thing. So I'm not a conspiracy theorist, at least not yet, although I do watch all of those shows that deal with that stuff. Like there's a show that has a computer that sees everything, knows where you are. Can't remember the name right now. Person of Interest. Great show. Love that show. If you believe that that's what's going on in your life, this should be a little scary for you. But the bottom line is, it's how down to the minutia they've gotten with all of this stuff. So I am running out of time because I'm talking too much. Who prepares the closing disclosure form? This is interesting. This is sort of a bridge between Toby and me in terms of what we're going to talk about. But what every lender but one that I know has talked about, do you know of any lenders that are allowing us to prepare? No, I know of one. Every lender is going to be preparing the closing disclosure themselves. Yes, and the reason for that is because it has truth in lending disclosure information on it, and they want to make sure that the truth in lending information is accurate. We as attorneys have never been able to provide or modify truth in lending form. So settlement service providers are not deemed safe enough to provide that information. And more importantly, under Dodd-Frank, the lender is responsible for everything. Everything. And if you've read any of the industry stuff on this, you know that Wells Fargo has been hit with like $500 million in fines in the last 3 years by CFPB. It's unbelievable what they're doing to these lenders. And so lenders are very scared because many lenders couldn't afford a $500 million fine and still stay in existence. So the settlement agent is responsible for those portions prepared or delivered, but we're not going to prepare any of it, and we're also not going to deliver it. And we'll talk about that right now. So let's talk about the 3-day period. This is very important. This is where your life starts getting impacted. The closing disclosure must be provided 3 business days prior to consummation. What? How did sex get into this? The Consumer Finance Protection Board has come up with a new term for closing. It's consummation. Consummation is the time that the borrower becomes obligated to the transaction, which is theoretically by law in most states when they sign the promissory note. So 3 days prior to consummation, the borrower has to see their closing disclosure fully complete. That sounds like a great idea, doesn't it? Awesome idea. However, there are certain things that are going to make this a little bit challenging. First thing is, 3 days prior, they have to see it. How is it going to be delivered? That's the next 3-day period. The CFPB has said that snail mail is a good thing. Snail mail takes 3 days. To get 3 days to get from the time that it's sent till the time that it's received. So we just added another 3 days. If the lender who has to deliver this form, and the lender will be delivering the form to the borrower directly, if the lender is going to deliver the form to the client, they stick it in the mail, they count 1, 2, 3 business days, maybe 4. 1, 2, 3 days, maybe 4, depending on whether we have a Sunday. And then 3 days starts. 1, 2, 3. Now we can close. So, how does that work? This is how it works. Very simple. If the closing date is Monday, the disclosure is due the preceding Thursday, and therefore it has to be stuck in the mail the preceding Monday. Right? So no, I'm saying what the CFPB has deemed to be appropriate delivery times. So the question becomes, the question is being asked, what if we hand it to the borrower 3 days prior to closing? Theoretically, that would be sufficient. However, the lender is not going to start sending out messengers. So every lender that I know of, at least as of today, is taking the position that they need to stick it in the mail 7 days prior to consummation. Now, are there softwares out there that would allow for proof of delivery prior to that time? Yes. DocuSign, something like DocuSign. Email with a read receipt doesn't prove that they saw the document, just proves that they opened the email. So that's sort of a controversial one. But that's how that's going to all work. The closing disclosure has to be mailed a week prior to closing. There's another way to look at it. Changes. When can the closing disclosure, having been given to the borrower, change? Because we all know that nothing changes at the closing table. Ever. Nothing. Ever. Now think about this, and Toby will just keep it in the back of your head. I'm not preparing the closing statement anymore. Toby's not either. So I'm not going to, Andrea, hey, can you add this to the closing statement? No. Andrea, hey, can you call the lender? Get the closer on the phone. Ask them to add this to the closing statement. Make sure that they run this by underwriting, then get it back to us. And by the way, we're sitting in the room closing now. Think about that for just a minute. Sorry, Toby. The good news is that redisclosure is only required when APR changes by 1/8, a new loan program is considered by the borrower. So if we go from a fixed rate loan to an adjustable rate loan, totally new disclosure has to be given with the same time periods. APR changes by 1/8, or or the addition of a prepayment penalty. So the good news is For the most part, those things don't happen often. I will tell you when it will happen. It will happen when we are scheduled to close at the end of the month. We need to delay the closing by a couple of days, and prepaid interest goes from 0 to 28 days. And in that circumstance, APR will go up by 1/8, and we will have to give a whole new closing disclosure. So, there are going to be circumstances that's going to be interesting to play out. What are we going to do about the seller? Well, CFPB doesn't care about the seller. They're not borrowing money. So the settlement agent, Toby and I, are responsible to provide a closing disclosure to the seller. They've provided a document which looks remarkably similar to what they've provided to everybody else. It's a 2-page form that looks like the current settlement statement. It does not include loan information because it doesn't need it. Notice just the seller column on the second page, just the seller column. And on the first page, it does show adjustments between, it's going to have to show adjustments between the seller and the borrower, but not on a borrower column. It's not like you're showing the same transaction on both sides. It shows real estate agents, it shows settlement agents, and it gives the seller a bottom line. This is the only thing that the seller is going to see. They're not going to see the other closing disclosure at all. There is some talk about a joint form being used and signed and distributed to agents. I don't know about Toby's office. So far, we're not providing one. I mean, there's only risk in doing something like that. There's no reward for people like me in doing these settlements to do anything other than what is being instructed of us, which is to provide a closing disclosure to the borrower, a seller's disclosure to the seller, and theoretically, never the twain shall meet.
So theoretically, if you're representing the seller as an agent, you only need to have the seller's disclosure to give back to your office?
Well, again, CFPB could care less about what your office requires. I mean, they could care less. In most areas of the state of Connecticut, you don't get a closing statement. I know that sounds incredibly foreign to you guys, but when you go to Litchfield County, when you go to some areas of Hartford County, when you go to Fairfield County and you ask for a HUD, they look at you like you have 3 heads. They will not give it to you. They don't make extra copies. I mean, they don't make it easy, nothing. Those are the same places where in the past you've had to give a receipt for your commission, which is something you're going to have to start doing for us going forward. But your agency and what they will accept for their transaction is going to be up to them. But if you're representing the seller, unless you can get the borrower to give you the closing disclosure, it's not coming from your settlement agent. So Toby and I, it's nothing personal. We love you all just as much as we did on July 31st. We're just not handing you that form because we don't want to be in violation of Dodd-Frank because the penalties associated with it are crappy. All right. This new form does not apply to these transactions. So it doesn't apply to land, construction. Oh, sorry. It will apply to where it didn't apply before. It'll apply now to these transactions, vacant land, construction only in 25+ acre loans. RESPA will follow that. Not covered in the future, reverse mortgages, loans, institutions that originate 5 or less loans a year, and those loans will be using the old stuff. So the software that we use will be able to generate both documents. So, I'm sorry, I'm like 8 minutes late. Does anybody have any questions relating to that presentation only? Yes.
Giving them the packet within 3 days, is that after the purchase and sale is signed by both parties?
After the property has been identified by the borrower to the lender. Now, whether they are required to have a contract, that's an interesting question. I've never heard it addressed in any of the presentations I've been to.
I think the answer is no.
I would agree. The answer is no. If the property is identified to the lender, then the lender has to issue the loan estimate.
It could be during negotiation.
So theoretically, if there's no, for the people on webinar, does the loan estimate have to be given even if there's theoretically no contract, but the property has been identified? The answer is yes.
What happens to the ID number if the property's identified and they've gone to their lender with it, and then they don't get that property?
Well, then if that transaction falls out, then when the next property is identified, the loan estimate would have to be re-given with the new property.
Okay.
Couple more. Go ahead.
So who would we be giving the oil adjustment or the gas adjustment to?
Same. Sellers, theoretically sellers. Yeah. But Toby will talk about that stuff. Just this presentation. Okay, you've asked, you're up. Sorry.
Most buyers are concerned with closing on time. Does it make sense to involve them in going to their lender 3 days before to get the package instead of having it sent?
No. The question is, does it make sense to have the borrower go to the lender to get the closing disclosure, and then we can close 3 days later? The lender is going to dictate how that document is being delivered. And for us to sit here and speculate as to what any single lender will do is a waste. I've listened to many of them talk. They have no idea. Right now, it's amazing. Right now, they're going to stick it in the mail, whether it's FedEx or just a regular snail mail envelope. They're going to stick it in the envelope and send it out. And then they are covered by the 3-day rule. And that's what they care about. Are they subject to fine for violating this new rule? That's all they care about. They don't care about convenience. They don't care about closing date. They care about making sure that they comply with the new rule. If you have more questions, then we'll cover them. I'll be happy to stick around and cover them afterwards, but Toby's got a lot to say, and I've been speaking way too long.
You're speaking very well.
Oh, thanks.
All right. That's the good news. All right? The first, oh, by the way, I want to make sure all of you have this. Keith Turner and McHugh sent them up, and you're going to need this, and I'll explain that more, because you're going to be explaining this to your clients. Think about that. This is one thing, but there's a perfect storm coming your way. Because to understand this truly, you need to also understand that FHA, as you know, for some time has refused to have escrows unless it was weather related. We need to see the sow on the ground, set that aside. Other than that, there will be no escrows. And that will become a factor in what I'm talking about. And then there's a creature that's been around for over a year that you're not really into, but it affects John and I constantly, called best practices. The rules about what we can and cannot do. And one of the rules is the closing statement has to match the checks at all times. So that means we can't close and then start recutting checks because other things might be happening. All right, bearing that in mind, let's start with what he said towards the end about information to the borrower 3 days before the closing, not Sundays, certain federal holidays. Delivery period of that information to the borrower, another 3 days. The banks are now telling all lawyers they want the final information 10 days to the penny before the closing. All right? That's to meet the 3 days for the borrower to think about it, 3 days to deliver, and the bank needs some time to play with it. All right, so there's a 10-day rule that's now in play. And to understand this whole process, what you need to wrap your head around is closings no longer take half an hour, they take 10 days. Your closing is now a 10-day process. One, most of you have 45 days running from contract to closing. No, it's 55 days now. When you're preparing your contracts, you've got to give 55 days instead of 45 days because the closing is going to take 10 days. Next, John and I have to start doing things much sooner than we had before, as in searching titles, etc. Because we have to get everything from the seller's attorney in terms of payoffs to get to the lender, final numbers 10 days before the closing. To do that, we need to know that there's a deal. So do not hold your contracts to the last moment. Please give us the contract as soon as the deal is on. We need the contract the moment you have it, and all addendums. When we get that contract, we also need to know who the other attorney is. Sellers, for example, don't get to wait until 3 days before the closing to decide who they want to represent them. And one of the reasons, quite frankly, I happen to have a little squib here. John's probably got the same thing. If you tell me that attorney so-and-so is handling the seller, and by the way, he's a great divorce lawyer, or he's Uncle Willie, or whatever, I'm going to call the guy and give about a 5-minute presentation on what John just took almost an hour to explain. All right? No, that's all right. Listen, though, I've taken a lot of these seminars to prepare. That's the best you'll ever see, really. I'm not busting his chops. That is really the best. Okay, so you're getting us the contracts earlier. You're getting us the attorneys much sooner. Now, I said the perfect storm, other things impacting on this. A lot of you as buyer's agents do not want the buyer to spend any money on inspections until pretty late in the game. No. You've got to do those inspections as soon as possible, like in the first 10 days of the contract. All right? And the reason for that is you've got to find out if things need to be repaired, because all the repairs are going to have to be done before the 10-day start. Why? Because FHA / most lenders now, no escrows. Things are not going to happen during those 10 days. They will, but I'll explain that in a moment. So we need inspections as soon as possible, repairs as soon as possible. Now, that's going to create a friction point for you as agents. Quite often, something needs to be repaired, seller doesn't have any money. You say to the electrician, look, do the work now and you'll get paid at the closing. A couple of months from now, let's say Christmas or maybe the beginning of next year, there are going to be 1 or 2 electricians or mechanics that will wake up and say, wait a minute, I'm doing for work, but this hasn't appraised yet. The guy hasn't even qualified. I don't know if it's going to close. Oops, I don't think I want to do it that way. I think I want to get paid while I'm doing the work. That friction point will be resolved possibly because the seller turns out they really do have the money, or less attractive buyer will pay for the work not knowing whether they're going to buy that property. That doesn't sound very good. Or you're going to be creating a closing cost credit. Hopefully you haven't already used that tool. Or you're going to lower the sales price. But if you use the closing cost credit or the sales price reduction, remember that doesn't mean the buyer's going to have any more money to fix the problem after the closing. It just means he's going to borrow less, pay less. And now we're going to have a problem if it's a government loan and the appraiser said, no, that's got to be fixed before the closing. So these are the kind of things that you're going to be working on. Let me move to the next friction point. The 10 days, thank you. The 10 days are going to run. Suppose you're planning on closing on the 15th of the month. 10 days, therefore, have to start 10 days before that, right? What happens if, for some reason, you need to close earlier? The answer is simple. You're not going to close earlier. They're not going to cut in to the 10 days. Yes, Ann?
I find that a lot of times when they take the applications and they have the closing date, when it gets to the person in the back room and the closing date says July 25th, even though you've said in writing that the closing date changed because their house closed, so if the back room person never catches up and is planning on July 25th, not July 1st.
Okay. Let me go back to something. Okay, go back to something John pointed out. He mentioned the penalties and what happened to Wells Fargo. There's one scenario where a bank can pay a penalty of $1 million a day. Do you understand what I just said?
Yeah.
It's insane. You're never going to run into a more rigid system than starting after August 1st. In about 6 months, it'll probably massage, hopefully, a little less crazy. But for applications made on or after August 1st, things are going to be incredibly tight for you, for everybody, which is why there's going to be a lot of applications made in July. I mean, all right. But the closing statement, the closing date can't be pushed forward. What about delaying it? All right, that's fine. But as John pointed out, if you move from, let's say, the end of the month to the beginning of the next month, and the prepaid interest jumps up, and that triggers an increase of more than 1/8 of a percentage point in terms of the APR, oops, now we need another 10 days. Now, realistically, there are going to be some things that change during the 10 days. As long as it doesn't trigger new product, prepayment penalty, or increase in the APR, we're going to have a scenario where at the closing table, oh, it's X instead of Y, and we're going to have to call the lender and they have to reissue a closing disclosure. John and I was thinking about this about 2 or 3 weeks ago. I had a situation. I had a seller right at the table. He said, no, I'm going to pay the $250 instead of the affidavit. And John went into the back room and got it turned, the closing statement to the lender, corrected back to us in like 10 or 15 minutes. Okay. That's not going to happen anymore. Not even close. If there's a change at the table, think an hour, at least, because everybody's paranoid about a problem. Mention of oil adjustments. It's fascinating. We met initially as a group of lawyers, and we thought we'll have a summer rule and a winter rule. Winter rule, let's say from November 1st to May 1st, everybody's using 5 gallons a day, 10 days waiting period from when you read the tank in the beginning of the 10 days, and so that's 50 gallons, and we subtract from what it reads. And then on May 2nd, we had the summer rule where nobody's using any oil at all, and only lawyers could concoct that. Needless to say, that's probably not what's going to happen. But I haven't heard anybody come up with a really good one. For example, well, we'll just have the buyer burn the oil. Well, all right, let's say fill the tank, except there are a lot of buyers that don't have enough money to pay for that oil. Okay, let's go the other way. Seller's going to let the oil go down to almost nothing. In the dead of winter, doesn't sound like a good idea if it doesn't close on time. There are going to be some fun things. There's no way around it. But one thing we do know, that whatever numbers we gave at the beginning of the 10 days, if a penny changes, then we have to redisclose. All right? Now, as John went through this, he also pointed out it's not clear what kind of a document you're going to be taking back to your manager or broker to go with the check you're bringing back, and the managers and brokers want something. In our case, most of us, I think, are going to be giving you our disbursement sheet, so that you're going to have some piece of paper coming from us that shows what your commission is. For a while, I was thinking, maybe we can get the buyer to waive the closing disclosures being given to you. And every single lender that I have talked to said no, absolutely unequivocally. They're terrified of the privacy, the confidentiality of this information being given to the wrong person.
We have it now. We've had it for 50 years.
We've been violating the law for at least that long. But now they're paying attention. Let me give you an example, very briefly on this. 3 weeks ago, an agent got some information from a buyer to give to a bank. She inadvertently sent it to the wrong person. Now that's a nuclear strike. She had to go to the person, explain what she did, and that person is now changing all her credit cards and all her checking accounts. Fortunately, nobody else knew that she did it. But if John or I accidentally sent this kind of information to the wrong person, we'd be killed. Under CFPB, under good practices, whatever. Yes, Chief.
Somewhere in a presentation, someone taught that there were categories to differences in tolerance ranges in terms of these statements. On non-loan items, like an oil adjustment, that's a consumable item. That's not a rate or a lender cost.
No.
There's no tolerance for change in that.
It's not a tolerance issue, but what the borrower gets 3 days before the closing has to be to the penny and has to be every dollar that he's spending at the table. That's the problem. In other words, CFPB said, okay, we don't want anything going around. We want it all
under. There's zero tolerance once it's disclosed.
In a sense, yes. Once it's disclosed at the beginning of the 10 days. In the sense, well, wait a minute. In the sense that we'd have to redisclose.
In the sense that we'd have to provide a new closing disclosure.
Yes.
you don't have to wait 10 days again unless the 3 items that we talked about apply. In the case of an oil adjustment, the concern that I think Toby has, I have the same one, is that if we change the oil adjustment at the closing table, it's not a question of me going into the back room, generating that document. We have to get in touch with the lender, who's the people generating that document, get them to make the change, wonder whether the lender is now going to bring that back to underwriting because the borrower needs another $373 to close. Have they verified that the borrower has those funds? How long do you expect to sit there and wait for that? I mean, all of this is going to happen. I mean, it's going to happen.
Yeah.
So that's why, zero tolerance is a great idea. Whether it's not going to work all the time, but it's what we should all shoot for. I think is what Toby's trying to say.
Yeah. Hold on, man. I want to go further on this, though, to the next point, and then I'll get back to you. Your walkthrough. It's really simple. You're going to be doing it twice. You're going to walk through before the 10-day start to make sure all the repairs are done, because there are no escrows. There won't be any money floating around once the 10 days start. And then you're going to walk through the day of the closing, make sure the house is still there and the people have got all their stuff out and didn't bang up anything. So realistically, there'll be 2 walkthroughs.
Now, new construction is going to get really crazy, waiting for the CEO.
When you're buying from a bank, when it's a short sale, you're going to need to be highly medicated. Okay? And
The William Raymond State. Sometimes.
fully disclosed as part of the commission. All those numbers have to be to the bank
So you
10
have
days
to know
before.
whether you're paying it or whether the client's paying it 10 days.
That's why I want you to think of a 10-day closing, because we want to freeze as much as we can what starts 10 days and ends 10 days later. Okay, yes.
So, when will the realtors be seeing the disclosures? If we're not getting a copy of it.
You're not.
How are we going to check our commission? Because that's.
You're going to get a check, and in my case, and in most other cases, our disbursement sheet.
I've sat at the closing table where there's been issues with commission.
I like to give our closing statements out as soon as you walk in the door to make sure we got it right.
Right.
Mm-hmm.
But
Not
then
going to happen.
If they're on the wrong side, or if they're not right, then what?
You're going to get a disbursement sheet, and you're going to see, I think I'm supposed to get 5,000. Oops, it's 4,500, and tell us. But you're not going to see the closing statement unless that softens and changes, and I don't think it will.
If there's an error in that, then what happens? Is there?
It has to be corrected then, and you'll know about it.
The lender
because
has
of
to
the-
correct it.
No.
Because
Well, yes. If for some reason we've got it wrong on our closing statement that's not called a closing statement, then
Because I get some from our attorneys a couple days ahead, so I see it, and this way correct any issues if there are.
that's unusual. You've got to give us a written statement of what your commission is, but that's because of best practices. And then we're going to, yeah.
Can you guys keep it down a little bit, please? And when you ask a question, ask it loudly so that people can hear.
On the webinar. All right, the one thing I want to end with is an interesting point that has not been resolved at all. You have to remember, from what John said, that this is focused on protecting the consumer. So the word and the concept consumerism is driving all this. Okay, makes sense? Except this, in this regard. This loan has to be for consumer purposes. The drive is on consumers. If a person buys a house where he's going to live and wants a loan, that's a consumer loan because he's going to use the money as a consumer. What happens if somebody buys a house and it's an investment? Probably if you ask 10 banks, you're going to get 15 answers. That's one of the weirdest parts of this thing. It's not the nature of the real estate that drives it, the collateral. It's the manner in which it's used. But remember how tight I've talked, and John has mentioned the penalties. We may be in a situation where a consumer loan, they're not sure yet how that's going to be interpreted by CFPB. They may insist on this. So there are going to be some ambiguities. Another example is powers of attorney in and of itself. If I give John a power of attorney and then I get on a submarine and I'm at the bottom of the Mediterranean, John right now can go to a closing, sign all the documents as a borrower. But what happens if this, I'm under the Mediterranean and they have to give me this closing disclosure 3 days before the closing. Can they give it to John? Well, we may have to start devising a power of attorney that specifically says that he has the authority to receive that notice. Because in and of itself, most powers of attorney don't even think about that. There are going to be, and this is really what I'm getting at, a lot of fun over the first 6 months at least, while different banks figure out different things. So one of the things you're going to be doing when you start talking about which bank to go to is you're going to call the bank and say, what's your version of this? It's not going to be the same. It'll probably a year from now, we'll all laugh about this. It wasn't that fun, but getting there is going to be more fun. That's it.
Talk about best practices a little bit as it relates to settlement service providers.
All right, well, the best practices is something that started a little over a year ago, and it addresses a lot of things. It was supposed to be best practices for real estate lawyers, and we thought, okay, it's going to be about real estate. Well, not really. It has two essential aspects to it. They're called severed pillars, but they're two that I think are really, from my perspective, the biggest ones. The first thing is an absolute control over information and preserving its confidentiality. I used to have a desk for a paralegal where as you're walking by, you could look over his shoulder and see what she was doing. Now I have some walls so that they're hidden and what's on her desk is confidential and covered. The second thing is the way we do our accounting, the way we check every month, every 10 days, in one case every day, that we're doing the right thing with the money and putting it in the right place. And in fact, there's a system now, if you give a list of the checks you've written today to the bank on which it's drawn, then they're only going to honor those checks. So the control of the money is a lot tighter. But the biggest thing from my perspective with respect to this is that the closing statement must match the checks. Now, well, there are going to be certain lenders that say, look, I understand that you need an escrow, but let's not extend it another 10 days. And why don't you all go out to the parking lot and do that? I want you to remember that, A, the lender's not going to be out there in the parking lot with you. It's just going to be all of you. So the only real question is how much is involved, because that's how we can decide whether it's a felony or a misdemeanor that you're committing. True. Do not go out in the parking lot. All right? Any questions of John or me? Ann?
This is something that comes up at a closing. And the real estate agent says to their buyer, I will pay that for you. So it doesn't have to be a problem. Could that be done if it's a $200 or $300 item?
I'm not sure. Again, theoretically, the borrower had to know 3 business days before the closing. Pardon? Okay. Well, the question is how to play at the closing a small dollar item, and possibly somebody's going to pay it other than the borrower, as in maybe the real estate agent. And I'm not really 100% sure how we're going to do that, because one of the unequivocal drives here is the borrower had to know 3 days before the closing exactly how much they were going to receive, or have to pay, excuse me. I would guess that if a borrower is paying less than they were told 3 days before the closing, common sense would say, that's good, we don't have to redisclose or deal in any way with that issue. But as you see, common sense has nothing to do with what we're talking about here. This is from Washington. I'm from the government. I'm here to help you. All right.
What I was just going to talk about is, Toby's talking about this best practices thing. What it comes down to is that attorneys, settlement service providers, are required under Dodd-Frank and many other laws to act in a certain way. The lender, under Dodd-Frank and many other laws, are required to act in a certain way. CFPB has been charged with monitoring that. And as a result, what they've said as a group is, hey, guys, settlement service providers, you need to rise to a certain level in order to be qualified to do this work for us. We don't want to be worried about if you do something wrong, we're going to get nailed with a big fine. And so I think what you're going to find in the industry, and I've talked to many attorneys around here, that they're just not in a position to do it. They're not in a position to be compliant. So what's likely to happen starting August 1st is the lenders are going to include in their closing instructions to us some affirmation that we are best practices compliant. Best practices were those pillars that Toby was talking about. There's 7 of them. They were promulgated by the American Land Title Association. And we're going to say to the lender, oh yeah, by the way, no problem. We're best practices compliant. We've done all the things that we're supposed to do. And that's the end of that. We sign our name. It goes back. Everybody's good. That'll be the case for 6 months, 8 months, until the lenders get all their crap in order. And now they'll start worrying about whether Toby is in fact best practices compliant, or whether I'm best practices compliant, whether Chris Albanese is best practices compliant. The people that do the work. And what you're going to find, and like I said, I've talked to many of them. I'm not going to mention their names because I just wouldn't want to do that. But they said, we're getting out of the business. We're not going to do that kind of work. So it's very important that you talk to your attorneys, your settlement service providers, make sure that they are up to date on all of this stuff. If you say Alta best practices and they say, then maybe it's time to find a new settlement service provider.
It's not an easy thing. We had an associate in our office draft the primary documents. They're that thick. Okay? It's not just let's have 3 pages and we'll say how nice and wonderful we're going to be. And it permeates the entire system. In my case, I even had somebody come in and run an audit against us. Not a full audit, and identify some issues we had to change. It's a serious thing. Yes, Dean.
Is there an outside date at which the application being taken before August 1st and not yet closed will run out, like 7/15, the application is taken and it's delayed until May of 2016?
No. As far as I understand, if you applied for the loan before August 1st, that's the old way. If you apply on or after, that's the new way. And there's still going to be, remember, a cash deal would not be this, because there's no lender. So you'd use the old way.
There's a question on the webinar that one of the webinar attendees have asked whether this is a Connecticut or a national rule. This is a national rule. This is everywhere, same form everywhere, just like the HUD-1 settlement statement is used everywhere in the country.
Melissa, did you have a question?
I did. I had actually 2. One is, how will an assessment be handled on this form if it's an association and there's an assessment involved? Will it be on this HUD or no?
It'd have to be if it's up first. If it's paid by the buyer for some reason or assume, no, it wouldn't be. I'm going to guess yes. Like any other lien, that would have to be there. What else?
Second question is, for instance, on new construction, when there's punch lists, I know there won't be any escrow. So essentially, even for new construction, you would be doing your walkthrough 10 days prior. So we really need to get these builders.
Yes, but by the way, we didn't get into it. That's a very interesting ramification that you should touch on, because I was trying to be shorter than normal presentation. Think about what she said. On new construction, there won't be any escrows at the closing. Even if you've negotiated to have them, there can't be any escrows at the closing. So you're going to find a few of us that are dragging off the closing a little longer, hoping to get more work done so there are no large ticket items. But I don't think the builders understand what a godsend this is to them, along with FHA.
But on new construction loans, they never close on time. So what is that going to do?
Okay, the 10 days start when the bank's got the okay to close.
Okay, so it's after the CO and after.
Yeah, and that's why I'm saying it's not a 45-day period, it's a 55-day. It's a 10-day closing. Yes?
I'm a little concerned about our buyers and sellers' reaction to all this. Once we start talking to them, and one thing is their cost. Is the lender cost going up because of this? Their fees or anything like that? Or attorneys going down?
This is the... How can you possibly think that?
You need to speak up. None of us heard you.
In other words, we have no good answer for you.
Okay. There's no rule saying that they
want everything.
Okay, CFPB has said, basically what they've said to that is they don't care. They know that this is costing the industry billions of dollars to retool to comply with their rules. They realize that there is a cost to compliance, and they don't care. So I'll answer the question directly. Costs are going to go up. Settlement services eventually are going to go up. And the reason they're going to go up is because there are going to be less people doing it, and it's going to be more complicated to do. So in my opinion, this whole thing is going to cost the consumer money, but CFPB doesn't care about that. They care about understanding and transparency. They don't care whether that costs money.
Also, yeah.
Is it mandatory that the lender put it in the mail, or if it's a local lender, can they just come pick it up and cut 3 days off of it? Or do they have to?
I think initially, and disagree with your thing, I think initially all lenders want to stick to that because they're certain what that means. They don't want to take the risk of trying something intelligent and find out that it's not acceptable. Maybe in 6 months from now they'll say, yeah, let's have a different system. You other questions?
Yeah.
I'm sorry.
I was just going to say, CFPB has said that they're going to spend the first 6 months watching, learning, and they're open to modification if they find out that this all doesn't work. But I agree with Toby in terms of the answer to the question, and it's like I said, they know what 3 days in the mail, 3-day delivery means. They know. It's really simple. They put it in the mail on Monday, you close the following Monday. They can't get nailed for that.
They know they're compliant.
They know they're compliant.
And that's all they care
And
about.
that's what they care about right now. Now, that might change. And that's why the first 6 months, 8 months is going to be interesting.
You have a question?
Some buyers or sellers like to sell and then purchase something on the same day.
Back-to-back
Is that
closing.
going to ever even be possible in the future with this?
As much as any nightmare that I can think of, yes. But that's a piece of cake. Wait until you're doing a short sale and you get the payoff and says you have to close in 7 days or something idiotic. No, it's not. Yes, yeah, Jen.
Will getting the loan balance that needs to be paid off become more tricky because of these rules surrounding confidentiality?
No, but look, that's why John and I are going to need the contract earlier, to search earlier, to get to the seller's attorney earlier, and make sure he understands he's got to get that payoff earlier, because we need to give that information to the buyer, to the bank, to come up with all this. And some lenders, by the way, want 5 business days to get a payoff. So the divorce attorney thinks he's going to start thinking about it the day before the closing. He's not on this planet.
Yeah, because that's going to change. That's a number that will change if the closing is delayed or if we, close.
But that change, it doesn't trigger another 10 days.
Okay. Because it's the seller now, you're the seller.
Based on what you're saying, then, unlike what we did before, the buyer would have to contact you, the attorney, almost immediately. Will they not? Yes.
It would help.
Because you have other charges, like what is it, what you have now, the $250 charge for the.
Title search?
Yeah.
All that stuff is going to be disclosed to the lender.
Yeah. They're going to have a sheet.
They're going to have that.
Each one of us saying what we're going to
They're going to dictate in large part what we charge too. So, at least some of them.
Yeah.
Anything else?
John, you mentioned that we're going to have to supply a commission receipt. Is that going to be served the same way as we currently do with our letter?
We're supposed to be doing that already under best practices.
Right. So the letter we've been doing is suffice.
Yeah, nothing has to be in a specific form. Okay. Just providing a document showing a charge for your commission that corresponds to the check that we're issuing.
So we probably wouldn't be able to hold out the deposit any longer.
Sure you could. Same thing. Yeah, no problem. Yeah.
All right. Thank you
very much.
And good luck. Make sure that you keep these, because you'll be explaining them to your clients.